saw her sending money all types of ways today, and I tagged Kim, but if Kim tags picture, she will also tag her name on it. So it's free exposure.
Right. That's great, dude.
Yeah, she will post on everybody who says that.
What's going on, guys? Good morning. Let me know if you guys can hear me all right, and we will get things going. What's going on, Big G? Let me know if you guys can hear me okay. Yep. All right. So, guys, by the way, there is a very slight latency on the feed. So I'm definitely watching everything you guys are saying in regards to your comments. But if it takes a second for me to reply back, that's because our latency is a little slower than usual. We'll update the latency so that way it's ultra fast. So when we see it pop up here, we'll be able to answer away. All right. So what's going on, guys? Welcome to live Forex trading here in on the Top Trader channel. We're going to be doing this every morning, Monday through Friday. We've been meaning to do it. We ran it back probably about 6 months ago, and it was so great. We had over 500 folks on the stream, and so we just might as well just start going at it again, right? We pushed out a video, what was that, just yesterday, where we spoke with Michael Pinto. All right, Michael Pinto is managing millions and millions of dollars over at Pinto Portfolio Strategies. He has a very interesting concept, which makes a lot of sense, but his whole portfolio is structured based on economic cycles. All right. And so as of right now for Michael, you got to understand, right? Think about this. You know, we are right now seeing enormous amounts of unemployment, right? We have monetary velocity at some of the lowest levels that it has been since the 1930s, right? Yet, right, if I show you guys here what we're looking like on our S&P 500, we're holding the highs, and it looks like we're about to touch on the 3,000 number, which we predicted yesterday inside of the Traders Lounge, our private community. So it does seem like we're going to continue breaking these highs. It's pretty interesting. It's pretty interesting to see that this is the case. As you guys can understand, this is the case simply because of the Fed. The Fed is all the way in on making sure that this market is propped up. And there's really nothing you can do about it, because think about it, guys. I mean, if you let bygones be bygones, if the Fed stepped back and again, who's to say that this is a good thing or a bad thing, right? But let's just talk about them not intervening at all. If the Fed steps back and does not touch markets, does not give the airline industry billions of dollars, does not print and put on the balance sheet $3 extra trillion of capital, right? What happens? You know, you probably have the S&P here trading back down to its lows. As you guys can see right now, we are at 29.68. I'm going to clear the screen here real quick, and we'll start some drawing. We'll start drawing some things up. But, you know, you do you have a retest? Are markets going to stay propped up? You got to think. The last resurgence that got us to this point where we're sitting at 29.67, basically the past, really this week, it's Wednesday. Since Monday, we've had a massive price move to the upside. This single day here on Monday, where we saw a 3% run on markets, can anyone guess what that was? Right? That was the idea that we were going to get that stimulus bill passed. It passed the House, right? It was going to be an extra $1,200 straight to the U.S. Straight mailbox money, right? But unfortunately, right, it did not get passed. The Republicans in the Senate did not push it on through. But we saw a tremendous amount of capital flow back into markets on this optimism that, hey, more stimulus is coming. Guess what? We're going to start buying more stocks. So when I say we, I'm meaning, these larger institutions that have been sitting on cash, higher percentage of their portfolio on cash. Again, they're trying to make a move. You got to understand, like Michael mentioned, pension funds, they can't go cash. The Atlanta pension fund, let's say the Atlanta pension fund for teachers, and let's combine that with the entire Georgia pension fund. Let's combine that with South Carolina, and let's combine that with the more private sectors. Let's say the whole southeast of the United States. There's hundreds and hundreds and hundreds and hundreds of billions of dollars that has to go somewhere, and they can't just sit that money cash, right? So they have to do what? They have to go over to treasuries, so on and so forth, but they have to move the money. And this is why we have such an advantage as retail traders. We can sit cash so quickly, and we can get in and out of markets so spontaneously based on what we see here, but at the end of the day, these market participants, they don't have that advantage. So they have to crash, right? I mean, when I say they have to crash, I mean, these pension funds, they have to go with that sell side, again, unless they move over into the bond markets. But the Fed is also, again, propping up the bond market. So, again, long story short, I know we're going a little bit advanced, and we're going to be coming out with so much more content, but wanted to just, again, show you guys real quick. This massive run that you see right here that has happened in the past 48 hours or so, I'll highlight it, right? If we go over and take a look at Google real quick, we can see, and I'll change this coloring real quick. I know it looks a little silly. Boom, boom, boom. All right. We can see this entire bull run that we're seeing right now. We just broke the high on the S&P after this entire coronavirus deal. So right now we are trading at the highest point since coronavirus has started. This entire bull run has happened because of the idea that stimulus was going to pass. So, at the end of the day, guys, right now markets, they're going to do what they want to do. As you guys know, we have had a short bias where we have thought we are going to get a retest here. We were very public with that. We wanted to see a retest. And again, the Fed is causing that trade idea to fall flat on its face, right? So let's pull back down here in the structure. This is where we wanted to see markets run. So we knew that we were going to have some type of initial correction after Corona, right? After we hit that low. This is when we started to see that initial, the initial idea that the Fed was going to come in and intervene. We had a massive resurgence of capital go back into the markets there. And so then we assumed that, okay, sure, we pulled back 15%. Okay. We markets sold off 30% because of Corona. We pulled back 15%. All right, I get it. We had to have, maybe there was too much of a large reaction here when it came to markets pulling back. But at the end of the day, we're going to continue to get bad jobless claims. There is a lot of uncertainty. That's why the market's based off of uncertainty. You guys know this, right? I mean, the more uncertain people are as to how the economy is going to function, the less likely they're going to get involved in stocks, right? Pretty simple stuff. So we know that there's a tremendous amount of uncertainty. We should start to see some slight pullback here. No. Every single run that has been over a 3% run in this market, all right, since March 15th has happened because of Fed news that they were going to intervene and prop markets up, whether it was airlines, whether it was the PPP program, payroll protection program, whether it was stimulus straight into the checks, straight into the mailbox of people. Every single time we have had over a 3 to 4% move in markets, it has been directly because of the Fed. Isn't that crazy? And again, it's not direct. The Fed is not buying stocks, but the optimism, right? The optimism that the Fed is going to come and save the U.S. economy is what is propping this market up. Okay, so interesting stuff. Let me take a look at your comments here real quick. Let me know if you guys, let me know what you guys think about all this stuff, man. It's pretty crazy. Sound is perfect. Awesome. Cool. Yo, guys, if you guys have any questions, let me know. I forgot to mention that. That's why we don't have any questions in here right now. If you guys got any questions, let me know. We'll run the tape. We're here for the next 20, 30 minutes, man. I just really enjoy spending this time with you guys, just going over markets. It gets me back involved in markets. I'm so busy on the business side of things. Everyone's like, come on, Cleve. Come on, man. We got to get you back in the game. And we have another interview coming out as well. There's an amazing individual, money manager, Brent Johnson. That'll be dropping sometime later on this week. We might do one a week, so that one might drop on Monday. We have another interview also with Kristen. Kristen, she has been on Fox Business, She is a mogul in and of itself, and she's going to give us amazing insights. So here's a fib real quick, guys. All right, so take a look at this. Here's our fib. We have pulled back up to the 61.8% retracement. Okay, this is where we thought markets could stabilize a bit, and we get that pull back down to the 23.6. We didn't end up getting that. All right, so that's where we're at. Let's take a look at our currencies real quick. Let's get out of the stock market. Oh, God, right? The stock market. Now, at least the currency, yeah, so currencies, are they manipulated? Somewhat, right? But at the end of the day, man, it is a lot easier. You know, this is why I love FX. It is a lot easier and it's a lot more predictable to play in FX markets than it is these stocks, you know, from the macro perspective, just because it takes so much capital to move currencies. You just really don't get all the jawboning and all the fluctuations that you get in regards to what's happening on the equity side. Now, is FX volatile? Yes. FX is also extra volatile because you guys are so highly leveraged, right? So, I mean, if you guys really think about it, if we were to like just throw in $100,000 into a portfolio with zero leverage, you'd be like, this shit doesn't move at all. You know, 1% one day, 2% another day. You're like, there's no volatility in currency markets. It's only when you apply that leverage that you see that currency markets are insanely volatile, right? So let's do it real quick. Again, I know this is like Forex 101, but a lot of folks have missed out on the idea that Forex isn't technically so leveraged. But let's say we take that portfolio of $100,000 and we turn that to a, let's pull back a bit. Let's take that portfolio to a $10,000 portfolio, leverage it just 10 to 1. Right? We're used to 50 to 1, 500 to 1 if you guys are some other traders. Let's just leverage it 10 to 1. And so now that 1% price move on $100,000 does represent, right? That does represent a 10% price move on the actual principal capital. So again, Forex markets really aren't that volatile. It's the leverage that incites or creates this idea of volatility. It's really interesting. Stocks, on the other hand, yeah, you can have, you had Spotify up 11% yesterday, right? Think about that. You had Spotify up 11% yesterday on the news that Joe Rogan, has just moved his podcast over, which I am a fan. I'm a fan of the JRE. Okay, let that be known. All right, so let's take a look real quick here. Our Aussie dollar. We know what's going on with the Aussie dollar behind the scenes. We know that Aussie dollar is the #1 trading partner with China. Australia's #1 trading partner is China. Okay, so we know that there's a direct implication when it comes to volatility and pain in China equates to what? Pain in the Australian dollar. How do we know that? Because, let's take a look here. All right, we have our March lows. Okay, we have our March lows here pretty well established for the Australian dollar. Corona starts to ease. What do you get? You get your up move. All right, now, again, New Zealand dollar as well, right? We know the New Zealand dollar also is correlated, but New Zealand dollar somewhat oftentimes doesn't have that as much of a dramatic effect, you can say, when it comes to markets. But I do really like the NZD. So let's start talking actual trades here before you guys rip my head off. You guys know me. I'll talk about everything besides what to trade. So real quick, interesting stuff, right? I like the structure here on the NZD. I like the idea that if we continue to see markets turning around, I was just listening to CNBC. Hey, I'm just listening. I'm not, acting. They mentioned that Georgia, there's less than 1,000 patients in hospitals. They mentioned Florida as well. Cases down 34% in terms of hospitalizations. You also have the U.S. If we look, we'll take a look real quick at the John Hopkins numbers when it comes to coronavirus cases, and you'll see that they are not only flatlining, but they are going down a bit. So again, you are starting to see that this could continue to scale in the favor of the NZD and the Australian dollar, which is why we could see a break of this structure. So that's something we are definitely going to be taking a look at there, a break of that structure. If I draw up a fib, just so you guys can kind of have an idea, gauge a little bit, where are we at right now in regards to this retracement? Really important to do that. Really important to do that. I'm not sure if you guys are using Fibonacci. Everyone should be. A lot of people use Fibonacci for interesting reasons. I just like to use Fibonacci to gauge where we are in the pullback world. You know what I mean? It just gives you so much context because remember, you can have a market that, let's just talk about the NZD here, right? We have NZD selling off dramatically. Well, first of all, we need to know why it's selling off. So we got to pay attention to the fundamentals. Okay. So once we figure out why it's selling off, then we can rationalize, okay, hey, and this is a Fibonacci lesson, but then we can rationalize, hey, what is happening here? What is happening here that is making it so that that sell-off, has slowed down a bit. And then if we can start to calculate that, hey, whatever it was that was holding markets back or that was hurting New Zealand dollar, we could start to see that evaporate, right? We could start to see market participants weighing capital differently when it comes to the NZD, which would give us a little bit of an up move. So right now we have the NZD sitting at a 38.2% Fibonacci. It's pretty interesting stuff. These are low retracements, so to speak. Now 38.2 isn't the lowest. We have a favorite retracement level. 38.2 isn't our favorite, but at the end of the day, it is a low retracement level, which means there is a possibility for a continued pullback. Okay, so that's basically all I'm trying to say. So could we fail at this high here, and could the NZD continue to meander in this range? 100%. But it's definitely something we need to look at, especially if we're thinking that, hey, Fed's propping everything up, massive amounts of QE happening. At the end of the day, if we start to see that the US dollar stops becoming that reserve, safe haven, we can start to see markets or market participants trading over and putting their cash into some of these other assets, NZD, CHF, not CHF, sorry, GBP, Euro, so on and so forth. Okay, so let's draw a little level where we could potentially see markets run up to. You guys can probably see it here. There is no science equation when it comes to how to trade, guys. It's really all common sense. It's just about you making the right decisions every day. I really like to say that profitability is a choice, right? And of course there are certain days where markets are going to do what they want. But at the end of the day, when you look at profitability over a longer time horizon, a month, 3 quarters, right? You really realize that most of the reasons why you did not see positive growth in your portfolio is because of silly decisions that you made, right? So you choose to make those decisions or not. And again, anybody that wants to do this on a professional, very well structured level makes the right decisions every day. And then that should culminate to profitability. All right, it's just my opinion, especially when you have an edge. Our edge is paying attention and keeping an eye out on the fundamentals. So let's see if we can get the NZD to run up into the structure. Now, remember, guys, this is the NZD index. Okay, so what this means is the NZD relative to all other currencies. All right, and so that just gives us a really solid idea as to what's happening in the NZD. I'm about to see if you guys have any questions here real quick. I'm sure there are some. Just a bit. Okay, I'll ask George's question real quick, just because it's the first one that I see at the moment. George asked, well, he first mentioned it's all manipulation. 100%, George, it is. It really is all manipulation. But then he asked, is the stimulus package Congress trying to pass stimulate the economy? So great question, George. So, you want it to, right? That's why they're doing it, right? They want people to take this $1,200 and they want to add a little bit more monetary velocity. So if we go back a bit and start talking a little bit about what happened in 2008, when it came to markets and how markets, capitulated, and the subsequent QE that was done in markets. Basically, they were printing money, right? They gave tremendous amounts of money to all the banks, billions and billions of dollars, right? Did that stimulate the economy? And so some people say, sure, it did. Some people say, no, it didn't. And I'm on the other side. I'm with the latter. I don't really think that stimulated the economy so much. Right? Because once that stimulus came in, yes, you had the banks that were propped up and the banks didn't fail. But at the end of the day, did it put the money into the pockets of the citizens, which is what the economy is ran off of? What did the banks do with that money? They did stock buybacks and they opened up the proprietary trading firms to gamble the money. They literally, when the government, so I don't know who here has had stimulus checks come in, but if any of you guys said, stimulus check, awesome, $1,200. I'm going to put this in my trading account. Well, look, that's exactly what the banks did back in 2008. Okay, so we're all human, right? We all think, the same thing. If you really don't need the money so much, yeah, you're going to put it in your trading account. That's exactly what the banks did, and that's all on paper. You can go look back at the balance sheet of the banks when they had that cash infusion, and you can see where it went. It's quite interesting, So today, though, right? You got to think, over the past 2 or 3 weeks. What have we had happen? We've had we've had the Fed, the government actually put money in people's bank accounts. Okay, so this is a little bit better when in regards to stimulating the economy. But at the end of the day, if people feel as if, they're a little bit nervous to do any kind of purchasing, in regards to, consumer purchases, retail purchases, even online purchases now at this point, you will not see that much growth on the retail sales side. And we're going to get the retail sales number, George, next month. We'll get the retail sales number. We'll see if there was an increase in retail spending at all because of, the stimulus. Maybe it's a lagging, effects, or maybe we'll start to see that the next month, but we'll see. In my humble opinion, I think we're going to have some of the lowest numbers in retail sales continuously. We already had a retail sales print that was really bad. We're going to continue to see those prints come out pretty negatively. So it's supposed to stimulate the economy, but if market participants are unsure as to what they need to be doing in markets, not market participants, if citizens of the market, if they're unsure, if they're fearful that they're not going to be able to continue to make an income, then yeah, they're not going to spend the money. You're not going to have an increase in monetary velocity, which means you're not going to have an increase in inflation, which means the idea of the stimulus stimulating the economy, didn't work out. Now, I do think that the stimulus helped. It definitely helped some folks. I'm saying, hey, look, if you're going to do it, do it. $1,200. Come on, if you're going to do it, put money in people's bank accounts every single month until we have cases down to a certain point or until you see a certain amount of traffic. I don't know what to tell you, but at the end of the day, you should commit to it. $1,200 is kind of laughable in my humble opinion. If you're going to print the money, just print the money. There's no reason to be conservative. You're printing the money. No one, you trust me. People are so out of touch with the idea that their money is nothing, right? Think about it. They just printed money that you usually work so hard for, right? I mean, 120 hours at a $10 an hour job, or 60 hours at a $20 an hour job, right? Or 40 hours. You get what I'm saying? So you worked hard for $1,200 in the past, but now the government can just put it in your bank account. People aren't going to catch on to that. They're just going to be like, where's my stimulus? I don't have it yet. You know what I'm saying? So at the end of the day, they're not conscious. So just give them more money. They're not going to catch on to the whole rigging and the whole fakeness of how this all works. No one's going to catch on. They're not. People don't, really read. I'm not an avid reader, but hey, I pay attention to shit at least, So that's what we're looking like. Again, I'm going to keep rambling on. These are going to be fun, man. These are going to be fun. Let's take a look real quick at the Japanese yen, just real fast. Let's see see what's happening on the Japanese yen. As we know, the Japanese yen, safe haven currency, one of the strongest safe haven currencies. What do we see? We see a massive amount of sell side coming in on the Japanese yen. Okay, so guys, as you can see here, and when did that happen, by the way? When did we start to see that tremendous sell side? Right when the idea of the Senate was going to that the bill was going to be passed for that second stimulus, we see a continuous amount of sell side coming in to the Japanese yen. So here, if we want to sell Japanese yen on the brink that there's going to be a continuous upturn and that the Fed is not going to let us fail, then we're looking at JPY sells as well. All right. So tomorrow we're going to have this structured a little bit better, where we're going to basically show you guys what we are looking at here over the past, today. But then tomorrow we're going to see exactly what happened. All right. We're going to see exactly what happened. We're going to talk about the biggest movers. We're going to see exactly where the currencies went and why they went that way. We're going to also be updating you guys on, potential policies that came out, from now until tomorrow. So every day we're just going to be updated continuously, and you're going to know exactly what is going on in markets. So I really want you guys to come back here real quick. We're going to do it in 30 minutes. Today we'll have some fun. We'll talk a little bit. Even tomorrow we'll have our segment, and then after that we'll sit back, relax, drink some coffee, and just, have a conversation about what's happening in markets. But tomorrow is going to be great because we're going to be able to put into context exactly what is going on today, Wednesday, and what ended up happening in markets. We'll also be giving you guys some ideas. I'll also be giving you guys some ideas on how we weighed capital in our room inside of the Traders Lounge in the Academy, which is now back open as well, by the way. Okay, so that's going to be awesome. We're going to tell you guys what we ended up playing, if we're still in the trades, so on and so forth, and why markets moved anyway. So make sure you guys are here right before U.S. session starts off. It's going to be right at 9:30. Okay. So that's our JPY. Let's keep an eye out on the JPY as well. These currency indexes are amazing because it shows us exactly what's happening in markets. Let's take a look here at the pound. No one's really been talking about the pound at all. The pound is selling off quite dramatically over the past, maybe let's say 2 weeks or so. And it seems like we're about to retest some lows. Here, let me make sure I'm answering all of you guys' questions. A bunch of them came in. Sasha Wilson says they printed 2 trillion, less than a quarter of it went to the people. You know what I mean? Look, man, if you're gonna print the money, just print the money. I don't get it. I don't see why we just can't print the money. Let's make everybody rich. You know, it's so great. I mean, to live in a rigged world. I mean, it's such a amazing. It's so crazy, man. I don't even know what to say about. You know, I don't even know what to say about how all this stuff is functioning, man. You guys need to watch that Michael Pinto video that we pushed out yesterday. All right, head to the Michael Pinto video here. Let me throw it in the chat real quick. I want you guys to check that out. You are going to love it. I'm going to throw it in the chat, and I want you guys to just have it up in the browser. We're going to end here soon. I'm a rambler, man. You guys got to bear with me. But I love talking to you guys, man. Let's see. I'm going to throw this in the chat. Check out Michael Pinto. Boom. Okay. Interview with all right, there we go. Right there. Dude, KJ, appreciate that, man. KJ, we got another one coming out, dude, with Brent Johnson. He's always on CNBC. He manages a pretty large portfolio as well. It's super awesome that these guys are coming onto the channel. Definitely excited to be tapping into the network here of traders. Also, our office is open back up, man. So if you guys are in Atlanta, if you guys are in South Carolina, if you guys are anywhere in the world and you want to fly out, you might get a cheap ticket, but then you can also pull up to the office here. We're trading here Monday through Friday, really almost 9 to 5. So yeah, that's the GBP USD. You know, again, not much happening right now with the pound. Let's not even talk about the pound. We'll talk about the pound later on in the day. Again, we have our 8 majors, right, that we're constantly looking at. But I really want to maybe pay attention or focus on maybe 2 or 3 currencies every live. So you guys let me know if you want to just kind of go over the 8, see exactly who our biggest movers were, but then focus in on 2 or 3, probably 3 of, you know, maybe some of the bit larger movers, and definitely ones that have opportunity on them. We'll do that for sure. Here's our dollar, okay? So take a look at the dollar, guys. This was one of the largest trades we had in the past, really all 2020, but almost in the past year or so. This move to the upside on the US dollar once Corona broke. Okay, so I want you guys to take a look at this. We calculated that Corona was going to be a dramatic trade for the USD. You guys can go back, watch some of the content in regards to what we thought was going to happen in markets, and we had an enormous move to the upside there. And as you guys can see, again, just like with the S&P, we pulled back dramatically. You know, we pulled back dramatically, and we're somewhat hanging around what looks like to be some type of a 15% off of where that base initially started. Let's take a look at the fib real quick. Let's see what we got going on. Let's see what's going on here. Boom, boom, bada. Okay, so yeah, we're at we're in between a 61.8 and a 78.6. So let's call it 70 near 75%. So what we see on the S&P, take a look at that, right? So right here on the S&P, we're at the 61.8. Right here on the dollar, we're right below the 61.8, which means the dollar overreacted, which makes sense. People ran to safety, okay? People ran to safety here on the dollar. So that makes a lot of sense that the dollar overreacted a bit, and that's why we're a little bit lower on that 61.8. But it's very interesting to see what we have happening here. So looks like our S&P 500 is at 2970. That's insane. I know you guys probably want us day trading like we're in. We'll be placing some positions on these lives. You know, but they will be swing positions. Best case scenario, they'll be 24 hours max, minimum, you know, but for sure we'll be placing some things on when we start to get this up and running. Just trying to get the format down if you guys don't mind, all right? So very interesting stuff here on the dollar. Again, if we continue to see the Fed intervening, we're going to get a dollar collapse. The dollar's going to collapse and trade back down to the lows. We're probably going to hit a 78.6. Okay, so let's start combining some of these currencies now. All right, this is the methodology that, you know, we really enjoy, which is kind of taking a look at the currencies individually. I used to have 50 different currency pairs up, right, where I would have the GBP JPY, GBP AUD, GBP USD, GBP, you know, NZD, and then I would be able to, and then I would have to look and see, okay, you know, I see the common theme there in regards to what's happening with the pound, in regards to pound being up or pound being down, right? But now at the indexes, I can literally just look at this one specific chart and say, okay, I like pound doing this, I like dollar doing that, smash, you know. And this is how you get what's called economic divergence. This is what we talk about in the academy. This is what all of our trades are based on. Economic divergence. That is the best way to trade in Forex. There's no other better way. If you guys want to break down on economic divergence, I'm here. Just say breakdown with 3 exclamation points, and I'll give it to you. All right, so let's see what we got. Let's take a look at, remember, we want to see a little bit of NZD strength, right? But at the same time, we want to see maybe some JPY weakness, maybe some dollar weakness. So what does that mean we do? Pretty simple, folks. We look at the NZD, JPY, all right? It is not that hard. Let's take a look. Now, the part that is hard is understanding the economics behind all this stuff. When it comes to the trading, like once you have the information in your head, once you have the knowledge, once you have the foundation, it's very easy. You know, and once you have a strategic process as to how you get in and out of these moves, it's very easy. It's the knowledge part that is confusing to people. Where do you know, or how do you gather all the information behind the currencies, right? So we like to say that there are 12 to 15 different fundamental catalysts that drive markets, right? And so those are the catalysts, and that's the information that we provide inside of the academy. And that's where trading can get very complex and convoluted. Is the timing element of getting in markets, the macro element of understanding why markets are moving, right? And just combining that all together, but then putting that in a repeatable process that is your strategy. You know, the analogy I like to use, or the mental framework that I like to use, not to use the word framework twice, is that a strategy is nothing more than a framework that you operate in, right? You operate inside of a strategy, and that framework allows you to discover your edge, right? For example, let's say that we are American football, right? So there's a strategy, right? So there's a strategy. Again, you guys might not know football, but bear with me here, right? So, okay, you have a ball. There's 2 teams, okay? One team doesn't have a ball. One team does have a ball. One team has to get a ball over a line, okay? So look, the long story short about that is there's a strategy, there's an idea in these guys' head as to how to make that happen, right? And there are different edges involved in that, though. They might have one guy that's fast, that's his edge, okay? But if his edge isn't utilized in that strategy, the edge doesn't work, right? So if you have the fast guy, right, throwing the ball, and the slow guy running the ball, then strategically you know what to do, but you're not using the edge in the right way. Right? And so that's exactly what it's like in FX. You might have a strategy that may work great, but if you're not using it in the right conditions, right, then guess what? It's not going to work at all. The better analogy is the basketball one, where again, your edge might be your height. You might be 6'7", I might be 5'9", right? And your best place to be utilizing your edge is right there at the rim, where you can get a rebound. It's pretty simple. My best place where I could be utilizing my edge, which I hope I have one at being 5'9", is my agility, right? Maybe I'm a little bit more agile, and so that way in the middle of the court, you have to be at the defense, and your height might be at your disadvantage. You might be a little bit more clumsy. So again, there's a conditioning, or there's a timing element to this stuff, and that's where traders usually mess up. They might know what to do, but they might not be doing it in the right conditions, so your strategy just doesn't work. It won't work. And that's where we come in and try to help people rationalize what that connection looks like. Okay, so we're looking at the NZD JPY. I honestly love this thing right now. I'm not going to lie. I'm just now looking at this for the first time, just like you. Okay, let me actually see real quick if anybody said breakdown. But I like this. I really do. Let's take a look real quick here at the. I want to draw open. I want to pull up just a quick structure. A zone. We don't like to use price levels so much, guys, like exact levels. You like to use zones because markets are very dynamic. So this is something that we tell all of our guys that, hey, if you're drawing a precise zone, like, hey, when markets breaks this very thin level, I'm in. You want to be careful doing that because that's how you get faked in and out of markets when you have these very precise levels. It's pretty interesting stuff. Breakdown, breakdown, 3 exclamation. If somebody doesn't have 3 exclamation points up, Desmond, dude, I need 3 exclamation points, bro. Oh man, George, you gave me 6. All right, I'm just kidding. So real quick, I hope you guys like this NZD JPY. Let's keep an eye on it. So I want you guys to keep an eye on it. Again, we want a little bit of JPY weakness based off of the structure and also based off of the economics. We want a little bit of NZD strength based off of the structure, right? We're right there at that level where NZD could see a push to the upside. So again, based off of the structure, the technical picture, and also based off of the fundamentals, the economics. And what that does, combination-wise, that gives us this beautiful painted picture here on the NZD-JPY, which is, again, it's quite interesting, right? How it kind of looks like how you would expect it to look. Markets trading sell side, consolidation here, and then again, we're right there at a potential break of that consolidation. So again, guys, this may not work out, mainly because who knows what could happen. If we see some type of uncertainty come into markets over the next 24 or 48 hours, this trade is going to be invalidated, okay? It's a trade idea. It's a hypothesis at first, okay? Sometimes you can put in a little feeler position to kind of say, okay, I like it. Let me test it out real quick. Let me throw in a little something real small just to kind of make sure it has my attention. I learned that from my mentor. And so then that way, you kind of keep your attention. Less than 1%, less than 0.5%. You just kind of throw something on just to kind of see what happens. And again, this is educational purposes only as well. All right, I'm not recommending anything to you guys. I'm letting you know what I'm doing and what I'm looking at. You guys are checking out Cleve's analysis. Okay, but it makes sense. It makes sense. If you guys have, if you guys think otherwise, please let me know in the chat. We can have a little, battle, debate, whatever you want to call it. Let's see. Okay. So economic divergence. Let's talk about it real quick. I'm happy to hear you guys want to talk about it. We got 114 guys on the stream. Man, in the next 2 weeks, we should be able to get that to 500 if we're sharing, if we're consistent, so on and so forth. All right, so I want you guys to imagine what I'm gonna give you guys a picture of economic divergence. It's very, very simple, which is awesome. But I want you to understand this, okay? This is not subjective. This is not Cleveland's idea on how to trade. All right. Understand that when it comes to anything in any type of business, right? Technically, some people like to consider traders entrepreneurs. You're taking financial risk, and an entrepreneur is someone who takes financial risk. But I really like to consider people who trade in capital. But at the end of the day, what are you adding? What value are you adding to the world? You know what I mean? This is a fairly selfish endeavor. And so I like to think of a trader as a capitalist more than anything, okay? You're literally taking advantage of the monetary system. That is what a trader is. Anyway. So when you're looking at economic divergence and you're trying to rationalize what economic divergence is, imagine this, right? And this is where your fundamentals on how Forex works comes into play. You have the US dollar, you have the US economy. The US economy, right? So if I had $1 in my pocket, let's see if I have any money in my pocket. Oh, look at that, big bucks. I'm a few $100. Let's talk about $100. So I have $100, okay? So 10 years from now, let's say 10 years ago. 10 years ago, I also could have had this same exact $100, right? Now, it would have looked the exact same, but its purchasing power would have decreased, right? We know that. We understand how that works in regards to inflation. But at the end of the day, $100 back then, if you fast forward into the future, it's a $100 note. You know what I mean? Does that make sense? So 2010, right? So the only way we can really understand the difference in value, like very, very quickly, like from a day-to-day basis, the only way we can really understand the difference in value on if a currency or an economy is doing well or not is if we compare it to another economy. That's the only way we can do it. If I want to know how strong my dollar is, this $100 is, a month later, I can wait a month, and then I could go to the gas station and see how many Twizzlers I can buy. It's probably going to be right around the same, right? But at the end of the day, if I want to go and take this $100, put it in the Australian dollar, okay, and then see the change in value, I will be able to see literally down to the penny, what we call the pip, right? 100 decimal places. 100% of a penny, right, is a pip. But I would be able to see the change much, much better. So we understand that, right? We understand that we need to be able to compare currencies to understand the change in those currencies. So what we want to do, though, is with economic divergence, again, this is very, very objective. We want to play a currency that is strengthening, an economy that is strengthening, versus an economy that is weakening. Any moment you enter into a trade where you have not rationalized, hey, this currency is doing better, this currency or economy, again, is doing worse. Based on whatever circumstance, who cares what it is? I don't even care if it's a technical idea. A lot of you guys, I haven't drawn up just a strict technical bias since, my young childish ways of trading. But back when I did, even in that scenario, even in that case, I still always try to rationalize, well, I only want to be trading a currency that is doing bad with a currency that is doing good. Economic divergence, it needs to be a foundational part of your trading, because guess what happens, right? There's something amazing that happens when you do economic divergence the right way. And there's one pillar of economic divergence that I won't throw completely out there, because this is something that we tripled down on in the academy. But I want to give you guys this part right here, which is still going to help you tremendously, all right? So think about it in this context, right? So if I'm taking a trade on the euro dollar, okay, and the euro, and I have done my analysis and I looked at my indexes, and the euro is getting stronger and the dollar is getting weaker, okay, relative to everything. So the dollar is getting weaker against everything and the euro is getting stronger against everything. So something amazing just happened there. Now, even if my dollar idea on dollar continuing to get weak, even if that idea is invalidated for some reason, maybe something happened, maybe there's some new optimism coming out of the economy based off of Trump or who knows what. So maybe the dollar becomes stagnant. Instead of selling, it becomes consolidated. If my euro trade idea is continuing its buying momentum, I'm still going to be making money because I'm buying the euro against the dollar, which is what? The dollar, which is consolidated. I'm still making money, right? So the only time you're not making money with economic divergence is if you get both of the trades wrong. And how often, are you going to be really put in that situation where you have fairly obvious reasons why to buy and sell something if you use economics? You have very obvious reasons why to buy and sell something if you give things a long enough time, right? If you're not doing this on a 5-minute chart, the economics should play out. And as the economics play out, you should be able to just see the trade work itself out. So at the end of the day, though, if you get both wrong, then boom, right there, yes, you are at a disadvantage and you're going to be losing money. But economic divergence not only is the best way to trade just because it gives you the biggest trading opportunities, it's also the best way to trade because it actually allows you to put yourself in a situation where one currency can actually be doing what you don't want it to do. But if the other currency is still making the move that you expected it to make, you could still be making money, or worst case scenario, you'll be consolidated, right? Or basically your trade will be break even until something else happens. But think about it, right? So if the dollar turns from being sell side to buy side, well, then you just have the euro buy side, dollar buy side. What do? You get consolidation, right? Now, if the dollar is more bullish than the euro and somehow it just completely reverses, like out of nowhere, completely reverses its trajectory, yeah, at that point, now you have the dollar, which is extremely strong, the euro, which is maybe kind of strong, maybe it's not doing exactly what you want, maybe it's moving a little bit, but not as much as you want it to, right? Well, then right there, you will have your negative P&L coming into play. And then, of course, if the euro is completely turned around, doing exactly the opposite of what you thought, dollar doing exactly the opposite of what you thought, boom, there you go. You have a situation where you're going to be losing that trade, more than likely, unless time, again, works itself out. Volatility is a crazy thing, and many traders don't factor in volatility as much as they should. It's one of the key points to our training is understanding volatility. So that's economic divergence, man, and I hope that makes sense because it could literally change your trading overnight if you understand its context. Let's see. Cool. All right. So yeah, let me know what you guys think of that. Excited to see you guys do well. Euro analysis. Okay, we'll wrap up with Euro USD analysis. We will wrap up with Euro USD analysis. All right, and let me know what you guys think of that economic divergence idea too. All right, so here's our Euro USD. Okay, here's our Euro USD. We are at the 109s. Man, markets selling off massively. Why are markets going sell side right now? Right? I mean, so if we're looking at from here, 2018, all the way down here to these lows, what currency is getting weaker? Well, the awesome thing is we can go look at our indexes, right? So here's our euro. Our euro since 2018. Wow, the euro looks crazy. Our euro since 2018 has sold off dramatically. We had a massive spike here on the euro. This is just the euro, not anything else. So we can see the euro index. And then we have markets selling off. So we know our euro has gotten tremendously weak since 2018. Let's take a look at the dollar. There we go. We have our dollar getting very, very strong since 2018. So what do you have right there, guys? That is literally your economic divergence. You've had the euro getting weaker and the dollar getting stronger. That is a perfect example of it. Euro USD. So if we take a look here, look how dramatic of a price move that has culminated to. Literally from the 125s all the way down to the 108. Crazy. All right. 1,700 pip move. Now, of course, that has happened over quite some time. But at the end of the day, it is a very, very dramatic price move. So now where do we want to go? Again, if we're thinking that the dollar is going to continue its sell side move versus the euro, I don't really think that's the case. I don't think the dollar is going to get so much weaker that the euro USD starts to pound to the upside. In the short term, we definitely could get a turnaround here. So, and this is the last bit of analysis we'll do, and we'll be back tomorrow, guys, 100%. So we're here to the low. We're trading right there to the, from the high to the low there. And we're not even at the 23.6% fib, which is interesting. And we are really just still trending sell side. So you don't yet truly have a very, very nice consolidation. You definitely have some consolidation here. It's not as large of a consolidation when you look at the context of this entire price move. So if you cut out maybe 2018 and you maybe just go a little bit more micro and maybe talk about what's happened in 2019 potentially, you may see that, hey, we might see a little bit more consolidation here. So here you go. We can see that we've already retested this red zone here. We broke out of it massively, right? I mean, we just really just ripped out of the thing and traded back up into this consolidation here, right? Traded right back up into this consolidation, pulled back. We failed at that high. And now there's another element of markets, which again, not subjective, straight objectivity. It's called price discovery. We might be able to see a retest back up into structure here on that Euro USD. Again, I just don't see in any world the euro performing better than the dollar. I'm not so optimistic about the now because, of course, the economy is doing better, but I'm definitely not thinking that the euro is going to kill off on the dollar. So let's keep an eye out here. We're at 109. Let's see if we can start to see markets trade right back up into the, potentially up into that 111 number. That would be pretty interesting to see. Let me know what you guys think of that, man. We're going to be here tomorrow. That's the cool thing about doing the lives every day, folks. We're going to be here tomorrow and we're going to be able to see what ends up freaking happening. Now, of course, the trade could be invalidated because of some economic reason or because of just straight up, that's how markets function. But our bias, my bias again right now is that we could potentially see a pull back up into structure here on the 111. Pretty simple. I didn't have to sit here all day, talk about candlestick patterns. I don't look at that kind of stuff. I think it's too minute. I think it's too minuscule in certain capacities. On the higher time frames, maybe not so much. I'm definitely paying attention to the fact that this bullish engulfing candle just broke this consolidation. I'm definitely paying attention to that. And that's a tremendous amount of momentum. And that's something you want to pay attention to. But when it comes to looking at candlestick patterns on the hourly, 30-minute, all that kind of stuff, I'm not really in that game. 4 hour plus, we can start talking about candlesticks. 100%. All right. So guys, let me know what you think of that euro back up into structure here. It will be very, very interesting to see us run up into this price level here. That'll be very, very interesting to see. All right. I want to know what you guys think of that. If you guys have any questions for me, let me know. I hope you guys enjoyed the live stream. It's going to be much more structured. It's going to be much more straightforward. Tomorrow we'll have a very, very solid Q&A. So tomorrow, come with your questions. We'll see exactly what happens. And I appreciate you guys, man. Okay. If you guys need anything from me, totally let me know. Let me see what you guys are saying here. Big G asked if Cleveland, do you ever check out any currency strength charts or apps? Hey, Big G, dude, absolutely. It's my indexes right here. My indexes give me currency strength 100%. It tells me exactly what's happening. And tomorrow, when we come back tomorrow, 9:30 tomorrow Eastern, we'll be able to see what currency performed. And we'll be able to basically go into the economics. We'll pull up Google. We'll pull up maybe CNBC, Bloomberg, look at some articles and see maybe why the currency did that. If I don't know, I should know exactly what's going on before I come on a live stream. But if something crazy happens, maybe a few hours beforehand, we'll be able to take a look right here at the pound or at the dollar, see exactly how strong it got relative to all the other currencies, and then we'll be able to start to do our due diligence and see exactly what ended up going on. And it could just be nonsense. The thing is, we may not see an exact economic reason why markets are running. It could be something. It could be what we like to just say sentiment. Okay, sentiment, underlying sentiment as to market participants just kind of having that feeling that they need to start buying this currency up. That's something that definitely moves markets. Okay. We start 9:30 Eastern. We'll be there tomorrow. What may be the cause of price action? We can talk about that tomorrow. There could be a couple of different factors in regards to what is happening with price action. What do you think about Bitcoin? Man, I don't think about Bitcoin. I got it. I'm sitting on it, and I ain't doing shit with it. Ain't nothing else to talk about. Just sit. You don't even worry about it. Buy it and just don't even think about it. Don't even think about it. Just buy it and don't think about it. That's the best way to handle Bitcoin, because who knows what's happening. All I know is I got in right around the $5,000 mark, and so far we have doubled and we're nearing 10,000. Not a huge. I'm not huge in Bitcoin right now, by the way. Like, it's not an enormous six-figure portfolio in Bitcoin. How do you gauge Bitcoin volatility versus currencies? Bitcoin volatility, man, look, dude, we can talk about Bitcoin. We definitely will have a day where we hit Bitcoin very, very thoroughly. But you want to be, you want to be straightforward with this stuff. All right. Thanks, man. You have a blessed day too. If you guys need anything from me, man, let me know. This was amazing. Very, very excited to continue to talk with you guys. I will see you guys tomorrow. We will push out some more content as well later on today. All right. Talk to you guys soon, man. Peace out.